Hey guys, welcome back to Marantz Rants. Plenty of good information, a little bit of motivation, a whole lot of truth, no financial advice. First, I want to tell you guys I was completely wrong about GameStop and what they're doing for the quarter. I had some projections. I was very out of bounds, and that's okay. That's okay for me to dream a little bit bigger than most, but I'll own it. I'll tell you right now, I was completely wrong. And after looking at the 10K, not being so emotional after a 7-hour live stream, I was able to break down a lot. The 8K told me a lot. The 10K tells me a little bit more, and of course, one of these updates tells me a little bit more as well. So I'm going to go over it with you guys. And if you're a GameStop investor and you see $12 a share, you see $13 a share, don't worry. I feel the company's worth a whole lot more. I can tell that it is just based off the metrics that we're measuring. Just to give you an example, guys, we'll go over it right here. This first is going to be the 8K. Okay, this is just a press release to give you a general idea of what happened with the stock and the company. GameStop came in at 1.7, almost 1.8 billion dollars worth of sales quarter four, down comparably to previous year of 2.2 billion. A drop off, a massive drop off. I didn't see that coming. I was blindsided by the number. What I'm happy I did see coming was the SG&A. I predicted 350, 360, 370 max, and it was right there, 360. So huge drop down from 453. That's $90 million of SG&A cut out. Look for that huge number to come next quarter. Next quarter for GameStop, quarter one of last year, they did 347, right around this number here. So I anticipate GameStop having about 290 range for SG&A. So that should be a huge run. We're looking at around 50 to 60 million dollar swing just on SG&A, meaning the profit could come through. We know that they lost around 51 million dollars quarter one of last year, but the net income was at 63 million. So even though the lower sales at the top were down, their margins were better, their business is better, more efficiently run. They made more money this year. They made 15 million more dollars this year, quarter four, than last year. That's huge. Profitability is up annually. They were a profitable company. And this is a manipulative number, okay? And I'm going to show people how that works, but we'll talk about it in a minute. Because the cash and marketable securities, this is the part that confused me. Because it's at 1.2 billion. They came in flat. And I'm like, wait a minute. They're not a flat company. Certainly not for quarter four. I know that they make money. I know that they do well. And because they had to have done well. I was just looking at the numbers. It didn't make sense to me. Well, here's how it worked. They used their money and they paid their bills, guys. They paid their balance sheet down, and it's all about liabilities at that point. So I'll show it to you. But the drop off to go from 5.2 billion from 5.9, essentially 5.9 to 5.2, you're looking at around six and a half, $650 million drop off on top line. Yet profits increased $300 million swing profit. So it's a complete turnaround for the company. This is the transition that you're looking for. And that transition of $650 million drop off on top line, yet the profits for 300 million. Look right here. This is your 300 million. SG&A cut out the fat, got you back there, and it's perfect for where you want to be. For me personally, I'm looking at 25% on net sales for the year is what it was, your SG&A, meaning it left you, COGS minus what it could be. So I love it. I love where you're at because you're at 6.7 million. It's as if Ryan wanted to come in right at a small number, not to show the world what they're made of yet. And this really tells me that they're preparing themselves for one of those great banner years. Maybe I wanted it this quarter. Maybe I was projecting it this quarter. But guys, to have a swing from $300 million loss to $6 million profit, it should be the darling of the stock market and everybody should be talking about it. And they're not. Everyone's ready to attack and pounce, and they're completely wrong. Adjusted EBITDA comes in at 64.7. That's fine. I really don't care for that compared to the 192 last year. No, don't care about that at all. Here's what I want to show you what I care about. When we go look at this company and we're comparing it from one year to the next, this is just a quarterly number here on net sales. What you'll look at here, you look at SG&A where it was down, like I told you. You had the gross profit of 419 versus 499. It's tough, right? You got to think about it. They have 300. It's 340 less, 340 million less in sales, yet their profit was only 70 million dollars off. So it's a good number. It's a good number to have, good problem to have actually. And their interests right here, operating right here. I'm trying to get you to where I want to get all the way down. So 63, perfect. This is not the part that I care about. I want to show you where it's at because it's hidden right here. Okay, so cash and cash equivalents. I was trying to figure it out. I was like, what in the world happened? And here's where it happened, guys, for GameStop. Right here. GameStop's accounts payable versus last year. This is the total amount for the whole year. They are $200 million less. Additionally, $200 million less here on accounts on accrued liabilities and current liabilities, meaning $400 million right here from 934 and 1.3. Now, why does that matter? That matters because there's a thing called current ratio. Whenever you evaluate a balance sheet, current ratio is going to be assets minus liabilities. What percentage is it? It could be 2x, it could be 3x, it could be 1.4, 1.5. If you're headed in the right direction, your number's going to be a little bit higher. So current ratio for GameStop, it being what it is, they actually carrying over basically no debt. They're operating on cash. Their cash alone can pay for the company itself. But let's go look at current ratio. So you go over here, current ratio. This is last year, right here. Look at this. I'll show it to you. Current 2022, boom, right? They're letting you know their current ratio, 1.74, 1.65. They're now officially at 1.97. They went up even higher. It's an all-time high for GameStop, meaning they're operating at the best efficiency ratio they've ever had on current ratio. And why? Because they're paying their bills. They paid their bills so much as I went down, I had to go look because you see last year, total liabilities, 1.3 right now versus 1.79. Almost $400 million worth of liabilities paid off. That would have been cash previously, is what they used to carry over. They would just carry over the cash. And you see it right here. This is it right here. You see this? $512 million. That's what they paid on cash versus the 354. Additionally, they had a tax credit of 171 last year. So all things being equal, they paid $11 million out of cash. That's the cash burn for the whole year, guys. $11 million. But what did they do with it? They paid $150 million just on liabilities there on one round. But as you look at the very bottom, what did they really drop off? They dropped off to pay the $500 million in cash. As far as liabilities go, they dropped off around $260 million, whatever it may be. Guys, this company is tightening up the balance sheet. It's getting real tight out here. Now look right here. Operating leases, as in they pay, okay? They're not carrying over. This is the cost. This is the cash flow. This is the loss. They're paying this quarter. This is right here, 53 weeks, whatever it may be for the year. They're paying $400 million worth of liabilities right here, okay? Versus what they didn't pay last year. So, yes, they're paying $400 million versus what they didn't pay last year. That's why they had a cash flow of $108 million in the positive last year. And this year, they're negative $200 million because they're paying $400 million on liabilities. They're tightening up their sheet. It's a great run company. It's the right thing to do. Now, another thing that happened out here that was announced is going to be right here. This is going to be a press release here, and it's going to tell you that Daniel Moore got promoted. He is now the principal financial officer of the company. He's getting paid $160,000. This is equivalent to the CFO just without the voting rights. But $160,000 plus options on stock. This is phenomenal, guys. Ryan Cohen is saying, I'm not paying a CFO. I'm not paying the C-suite. I'm not doing, you know how much Sean Goodman makes at Apollo, at Apollo, I'm so sorry, at AMC? He's making $5 million, $6 million with stock options and pay and bonuses. Not here. They're making $160,000. They got to work for their money. Now, yes, he is getting it in tranches. He's getting some pay, and he agreed. He did agree to the I would tell you it's right here. That's what I was looking for. So here's all the companies for GameStop up at the top. You'll see them. But Daniel Moore, he agrees for continued employment, and a total of $400,000 in transformational bonuses were paid out biweekly in a 2-year period beginning in 2021. Those bonuses have been paid in full, meaning that SG&A number is still coming back down. Now, his tranches on shares that are restricted right here, 15,000, play out for 4 years following the grant date, guys. 4 years, meaning from 2021 to 2025, he's still on that chart. There are other units that he gets here, and quarterly, right here, like 25% right here. Look at this. On January 1st, 25% of it. April 1st, 25% of it. July 1st, 25%, and then by October. So vested shares will happen, smaller amounts, 6,000, 3,000, 1,000. But definitely even like the 1,000 and the 15,000, he has to hold them for 4 years from that said date. This individual here is going to be in it for the long haul. It looks like Ryan Cohen is setting up his team, setting up the balance sheet to do just that. The last part I want to show you is what we uncovered. Go all the way down to page 19. I want to say it's 19. Maybe I'm wrong. Who knows? I've been looking at this for the last couple hours. You guys thought I went to bed, huh? I didn't go to bed. Here we go. So right here, it's going to tell you business priorities. Of course, establish omni-channel retail excellence. We've talked about this in detail. Watch the show. I tell you all about it. Achieve profitability, which we have done. Okay, the cost structure, the alignment, and the current anticipated future needs, it's all there. We are operating efficiently at a profit. Leverage brand equity to support growth. You will see growth within this stock and this company. You might see it elsewhere. You might see it in Europe. You might see it overseas, or you might see it domestically, depending on how far we shorten up this footprint. But here's the best part. It says investments. On December 5th, 2023, the board of directors approved the new investment policy. The investment policy subsequently on March 21st, which was just 5 days ago, the board of directors unanimously authorized revisions to investment policy to go ahead and allow the board of directors to oversee the company's investments. In accordance with the revised investment policy, the board of directors had delegated authority to manage the company's portfolio of securities investments to an investment committee consisting of the company's chairman of the board, which is Ryan Cohen, and 2 independent members. Could be Larry Cheng, could be Alan Adel. Who knows who it is at this point, but those are independent members of this company because they don't work for the company and their officers. Together with such personal advisors, investment committee may choose the company's investment must conform to the guidelines set forth in revised investment policy or be approved by either the investment committee by unanimous vote or the full board of directors by majority vote. Additionally, the investment committee may recommend to the board of directors further modifications to investment policy from time to time. The investment committee will direct the investment activity of the company in public and in private markets pursuant to authority granted by the board of directors depending on certain market conditions and various risk factors. Mr. Cohen and other members of the investment committee, each in their personal capacity or through affiliate investment vehicles, may at times invest in the same said securities in which the company invests. The board anticipates that such investments will align the interests of the company with the interests of the related parties because in places the personal resources of such. Meaning, I hope you guys understand what this means. Directors at risk in subsequently the same manner as resources of the company in connection with investment decisions made by investment committee on behalf of the company. What does all of that mean? I know I read it really fast and we can break it all down for you. It means that GameStop is going to allow the board of directors to invest their personal wealth along the line and alongside with GameStop's wealth. GameStop has $900 million worth of cash, 300 plus on marketable securities, 288 marketable securities. GameStop has money. And when they invest into something, these guys get to blow it up with it. They get to back it themselves because they are billionaires. Because Ryan is a billionaire. Larry Chang holds a damn $1 billion fund with Volution Capital. And who knows what's next. But I believe in this team. I believe in this group. This is the same group that invested seed money into Chewy.com, manipulated, maneuvered, did all the things they had to do to get that bought out and sold for $3.2 billion. Let's see what else they can find and they can invest and they can build. But I have nothing but time. And I know Ryan has nothing but time because that's what this looks like here. Looks like they took $400 million and they paid off their bills. They tightened up the sheet and they still showed a minimal profit. But I promise you guys, the $400 million, they didn't want to carry it over. They didn't want to carry over 200, 300. They want to leave it right where it's at. There's money to be made here in this company. They're showing you that they can. The sheet is right. The company's right. And you're correct. It's GameStop. Can't stop, won't stop, GameStop. That's the truth, millionaires. I may have gotten my projections wrong. I'm okay with owning when I'm wrong, without a doubt. But this investment's not wrong. There's so many people out there that are going to enjoy shitting on it for the next 3 months. But that's what you got. You got about 3 months, guys. And then what? What's your next excuse? Because they're going to keep showing profits. I'm letting you know right now. SDNA is coming all the way down $60 million for quarter one. How the hell are you going to beat GameStop for another year? You can't. Complete annual profitability was the key to success, was the key to not going bankrupt, was the key to everything. Let's see what else is next. GameStop, can't stop, won't stop, GameStop. I'm still here, millionaires, and I will be tomorrow. Peace.